$70. Silver just touched a number most stackers thought was years away. But there's a statistic circulating right now that should worry every single person who bought in at this level. 85% of retail traders are long silver at $70. And history has shown again and again, when almost everyone is positioned on one side of the boat tends to flip. So is $70 the beginning of a new floor for silver? Or is it the exact setup institutions use to trigger the next major shakeout? By the end of this video, you will understand exactly what happens next, and why the answer could define the next 12 months of the silver market. Welcome back to Currency Arc Insight, the channel built for serious investors and business minds who refuse to be caught off guard by what's coming next. If you're new here, hit subscribe now, because what we're about to break down could change how you position yourself before the next major move. Drop a comment and let us know which city or country you're watching from tonight. On a quiet Friday afternoon, something happened in the silver market that most analysts did not expect this soon. Silver crossed $70 an ounce. For years, this number sat far away on price charts, treated almost like a fantasy target that only the most aggressive bulls dared to mention. Now it was real, and traders across the world were watching it happen in real time. This was not just another round number on a chart. $70 represents something deeper. It marks a psychological ceiling, a level where human emotion, institutional strategy, and years of market history all collide at once. When an asset reaches a price like this, the reaction is rarely calm. Excitement spreads fast among retail buyers, while institutions quietly begin studying the situation from a very different angle. To understand how silver reached this point, it helps to look at what has been building underneath the surface for years. This rally did not appear out of nowhere. It was driven by two powerful forces working together, and both of them point to something far more structural than simple speculation. The first force is industrial demand. Silver is no longer just a metal for jewelry or coins. It has become a critical material for modern technology. Solar panels require it. Electric vehicles depend on it. Advanced electronics, from smartphones to data centers, cannot function properly without it. As the world continues shifting toward renewable energy and digital infrastructure, the appetite for silver keeps growing every single year. At the same time, mine production has struggled to keep pace. For 6 straight years now, the market has faced a structural deficit, meaning the amount of silver being mined has fallen short of what industries actually need. This is not a temporary shortage caused by a single event. It is a long-term supply problem that has been quietly building for years, and it does not resolve itself overnight. The second force pushing silver higher comes from the wider economic picture. Concerns about rising government debt, currency devaluation, and shifting central bank policy have pushed many large investors toward hard assets like gold and silver. When confidence in paper currency weakens, precious metals often become the safer choice for protecting wealth. This is not a new pattern. It has repeated throughout history whenever economic uncertainty grows. Has silver moved past major resistance levels, first near $35, then near $50, something changed in the way the market behaved. Momentum began to take over. Automated trading systems and algorithms recognized the strength of the breakout and added fuel to the fire. What started as a steady, healthy climb slowly turned into a sharp, almost vertical move upward, eventually pushing the price all the way to $70. For long-term holders who have been paying attention to silver for years, this moment feels like validation. The metal that many said was overlooked and undervalued has now proven its strength on a global stage. But for newer investors, jumping in during the excitement, this moment carries a different kind of risk, one that is not always visible on the surface. Because while the rally looks impressive from the outside, the speed of this move has created an unusual imbalance beneath it. The market has climbed quickly, perhaps too quickly, and that kind of rapid rise tends to leave behind clues about what might happen next. Something about the way retail traders have positioned themselves during this rally has caught the attention of serious market watchers, and it is not something that should be ignored. This is where the story becomes far more important than just celebrating a new price milestone, because behind this $70 breakout lies a warning sign, one hiding in plain sight within trading data that most casual investors never bother to check. And once this sign is understood, it changes the entire way this moment in the silver market should be viewed. Behind every major price move, there is a story told, not by the chart itself, but by the people trading it. And right now, that story is sending a signal that experienced market watchers know all too well. A recent statistic has begun circulating among traders, and it reveals something that should concern anyone who just bought silver near $70. 85% of retail traders are currently holding long positions in silver. This means the overwhelming majority of everyday investors are betting the price will keep rising. On the surface, this might sound like a reason for confidence. If so many people believe silver is heading higher, surely that must mean the rally has real strength behind it. But institutional traders and professional analysts read this kind of data very differently. To them, extreme positioning like this is not a sign of strength. It is treated as a contrarian warning, a signal that the crowd may be dangerously exposed at exactly the wrong moment. The logic behind this thinking is simple once it is explained. If 85% of traders are already long, that means most of the people who wanted to buy silver have already bought it. There are very few fresh buyers left waiting on the sidelines, and in any market, sustained upward momentum depends on new capital continuing to flow in. When the pool of potential buyers begins to shrink, the ability of the price to keep climbing weakens as well. This creates what analysts often call buyer exhaustion. The rally may still look powerful from the outside, but underneath the surface, the fuel that pushed it higher is starting to run low. Without new demand entering the market, prices can stall, even if sentiment still feels overwhelmingly positive. There is a second, more dangerous piece to this puzzle. Many of the traders who joined this rally late, chasing silver as it approached $70, tend to use tight risk management. This means their stop-loss orders, the price points where their trades automatically close to limit losses, are often placed close together, just below key support levels. To an everyday trader, a stop-loss feels like protection. But to large institutions and market makers, a cluster of stop-loss orders represents something else entirely. It represents liquidity. It represents a pool of forced selling that can be triggered if the price moves in the wrong direction, even briefly. And where there is a concentrated pool of liquidity sitting just below the market, sophisticated players often take notice. This is the uncomfortable truth hiding behind an otherwise exciting breakout. The very people celebrating silver's rise to $70 may unknowingly be sitting in the most vulnerable position in the entire market. Their optimism is genuine, but their timing and their tightly clustered risk management may have created exactly the kind of setup that larger players know how to exploit. None of this means the long-term case for silver is broken. Rising industrial demand, a persistent supply deficit, and growing economic uncertainty remain very real forces supporting the metal over time. But short-term price action rarely moves in a straight line, especially when sentiment becomes this one-sided. Markets have a long history of punishing crowded trades before eventually rewarding patient ones. This is why serious investors are now watching the data unfolding beneath the surface of this rally, instead of simply celebrating the headline number. A market where 85% of participants agree on the same outcome is a market standing on unusually thin ground. History has shown, time and time again, that when almost everyone leans the same direction at once, the outcome that follows often catches the majority by surprise. And this raises an important question that cannot be ignored. If the crowd is this exposed, what happens next if the price moves against them, even for a short period of time? Understanding that answer requires looking closely at how larger market participants have historically responded to moments exactly like this one. To understand what might happen next in the silver market, it helps to step back and look at how large institutions have historically responded to moments of extreme retail optimism. Their strategies rarely resemble the way everyday traders operate. Where retail investors often chase strength, institutions tend to test it, probing for weakness before committing serious capital. This is where the concept of a shakeout becomes important. A shakeout happens when large institutional players deliberately push the price of an asset down through key technical levels. Not because the long-term trend has changed, but because doing so triggers a wave of forced selling among weaker, over-leveraged positions. It is a calculated move, not a random one. If silver were to slip back below $70 even briefly, it could set off a chain reaction. Many of the stop-loss orders clustered near that level would trigger automatically, forcing traders out of their positions, whether they wanted to exit or not. Margin calls could follow soon after, adding even more pressure to the downside. What looks like panic from the outside is often, in reality, a mechanical process playing out exactly as institutions expect it to. This kind of sharp, sudden dip tends to feel alarming to anyone caught inside it. Prices fall quickly, headlines turn negative, and social media fills with doubt about whether the rally was ever real to begin with. But for large, well-capitalized players, this exact moment represents opportunity rather than fear. The panic selling created by retail traders exiting their positions becomes the very liquidity that institutions need to accumulate larger positions at a discount. This pattern is not new. It has repeated throughout market history, and silver itself has already shown a version of it in recent memory. After silver spiked to a dramatic high near $121, the price eventually corrected sharply, falling back into the mid-$50 range. At the time, that decline felt devastating to anyone who had bought near the top. But looking back, that correction did something important. It built a higher low, a foundation stronger than anything seen in the market for years before. What appeared to be a painful collapse in the moment actually became the base for the next major leg higher. This is a pattern experienced investors watch for closely, because sharp declines during a larger uptrend often serve a purpose, rather than signaling the end of the story. It is important to understand that a shakeout is fundamentally different from a genuine trend reversal. A reversal means the underlying forces driving an asset higher have changed in some meaningful way. A shakeout, on the other hand, does not change those forces at all. Industrial demand for silver remains strong. The supply deficit has not disappeared. Economic pressure pushing investors toward hard assets has not gone away either. What changes is simply who is holding the asset. During a shakeout, ownership transfers from over-leveraged, emotionally driven retail traders to patient, well-capitalized institutions who are willing to hold through short-term volatility. This transfer of ownership often sets the stage for the next phase of the rally because those new holders are far less likely to panic sell during the following dip or correction. This raises an important point for anyone currently holding silver near current levels. A short-term drop below $70, if it happens, would not necessarily signal the end of the bull case. In many ways, it could represent the market clearing out weak hands before continuing higher. The real danger lies not in the price movement itself, but in how unprepared traders react to it in the moment. Understanding this mechanism changes the entire way the situation should be viewed. Instead of asking whether a drop below $70 means the rally is over, the more useful question becomes whether the market is currently building the exact conditions needed for its next major move upward. And answering that question requires looking closely at what would actually need to happen for $70 to become real, lasting support, rather than just another level that gets tested and broken. Every major price level eventually faces the same test. It either holds and becomes a foundation for future growth, or it breaks and becomes just another number on the chart that traders briefly remember. For silver, $70 now stands at exactly this crossroads, and the coming weeks will reveal which path the market chooses to take. Rather than guessing, experienced investors look for specific signs that confirm whether a price level is turning into genuine long-term support. These signs are not based on emotion or hope. They are based on measurable shifts in how the market behaves once the excitement of a breakout begins to fade. The first sign to watch closely is physical premium expansion. In the paper market, prices can move quickly based on futures contracts, algorithms, and short-term trading activity. But the physical market tells a different story. If the price of physical silver bars and coins continues rising even while paper prices consolidate or pull back slightly, it suggests something important. It suggests that real demand, not speculation, is driving the market forward. When buyers are willing to pay increasing premiums for actual metal in hand, it signals conviction that goes far beyond short-term trading. The second sign involves institutional participation. Retail sentiment can shift quickly, driven by headlines, social media, or sudden fear. Institutional behavior tends to be slower and more deliberate. If exchange-traded funds and larger financial institutions continue increasing their silver holdings during this period, it suggests that professional money sees long-term value at these levels, regardless of what retail traders are doing in the short term. Consistent institutional buying acts as a stabilizing force beneath the market, absorbing selling pressure that might otherwise push prices lower. The third sign is a macro catalyst, something happening in the broader economy that forces new buyers into the market. This could come in the form of an inflation report that surprises to the upside, a shift in central bank policy, or growing concerns about government debt and currency stability. These events tend to pull in a different type of buyer, one motivated by protecting wealth rather than chasing short-term gains. When macro pressure aligns with existing supply and demand trends, it can provide the kind of sustained support that speculation alone cannot create. If these three conditions begin appearing together, the picture becomes much clearer. A market that holds $70 across multiple consecutive weekly closes, rather than briefly touching it and retreating, sends a very different signal than one that spikes and immediately reverses. Multiple weekly closes above this level would suggest that the market has genuinely absorbed the earlier rally, digested the extreme retail positioning, and built a stronger base capable of supporting the next phase of growth. If that happens, the implications extend far beyond a single price level. It would suggest that silver has entered a new phase of price discovery, a stage where the market is no longer simply reacting to a fast breakout, but is instead establishing a new, higher range based on real structural demand. For long-term investors, this would represent one of the clearest signals available that the metal's rise reflects lasting economic forces, rather than short-term speculation. On the other hand, if these conditions fail to appear and the price cannot hold above $70 with any consistency, the earlier shakeout scenario becomes far more likely. The market would then need to clear out the remaining overextended positions before attempting another push higher, a process that could take time and patience to fully unfold. This is the moment silver now finds itself in. Not a simple story of celebration, and not a simple story of fear, but a genuine test of conviction between short-term speculation and long-term economic reality. The coming weeks will determine which side wins, and for those paying close attention, the signs are already there. waiting to be read by anyone willing to look past the headlines and study what is actually happening beneath the surface of the market.